Nike and FedEx, once regarded as bellwether stocks for the US and global economy, find themselves navigating treacherous waters in the current financial landscape. Recently, Nike has sent shockwaves through the market by slashing its revenue outlook and implementing cost-cutting measures in the billions. The sportswear giant faces a barrage of challenges, including a revised lower outlook, increased macro headwinds, softness in digital traffic, and heightened promotional activity. Historically, Nike's stock has traded at around 30 times earnings. However, the current scenario poses a significant challenge as projections indicate a meager 1% growth for the full year. Adding fuel to the fire, emerging brands like On Holdings are gaining ground at a staggering 46%, intensifying the competitive landscape. Nike's lofty valuation combined with minimal growth prospects creates a conundrum for shareholders eyeing long-term returns. On the other side of the coin, FedEx, a stalwart in the logistics and shipping industry, has witnessed a 12% plunge in its stock value. This downturn was triggered by financial results falling short of estimates and a weaker outlook for the year, particularly in premium offerings like FedEx Express. This downturn hints at a broader global economic slowdown, a cause for concern on a grander scale. A closer look at FedEx's volume trends reveals weaknesses in premium services, suggesting a reduced sense of urgency in shipping and the potential buildup of inventory. The implications of these trends go beyond FedEx's performance. They serve as ominous indicators of a broader economic malaise. The question looms large: is this a temporary setback or a harbinger of more profound challenges in the global economic landscape? As investors grapple with these uncertainties, the dichotomy between Nike and FedEx becomes more apparent. Nike's valuation, once justified by robust growth, now appears precarious with the meager 1% projected growth for the full year. The emergence of competitors like On Holdings only adds to the pressure. In contrast, FedEx, with a valuation half that of Nike, presents a tantalizing prospect for investors seeking potential upside, provided there are improvements in growth or valuation expansion. However, the narrative takes an interesting turn when Wall Street analysts display a more optimistic outlook for FedEx's growth profile compared to the 2% growth predicted in the high case by AI ticker chat. This disjunction in predictions adds another layer of complexity for investors, underscoring the inherent uncertainties and varied perspectives that characterize the financial landscape. In navigating these tumultuous waters, it is imperative to underscore the three key components that can make or break investment returns: fundamental core growth, valuation, and free cash flow to shareholders. Nike's current predicament epitomizes the importance of considering these elements. The high valuation, coupled with minimal growth, raises concerns about the stock's long-term viability for shareholders. The allure of the Nike brand may not be enough to offset the challenges posed by emerging competitors and the evolving dynamics of the sportswear industry. On the other hand, FedEx, with its more modest valuation, could potentially offer a more attractive proposition for investors. The current slump in stock value may be an opportunity for those willing to weather the storm, especially if the company can address the issues affecting premium services and capitalize on potential improvements in the global economic landscape. The broader market context further complicates the quest for compelling investment opportunities. With the overall market trading at 20 times plus earnings, finding undervalued stocks with promising growth prospects becomes a Herculean task. The challenging landscape intensifies the scrutiny on companies like Nike and FedEx, making their trajectories crucial bellwethers for the market's overall health. In conclusion, the current state of Nike and FedEx exemplifies the intricate dance between valuation, growth, and market dynamics. Nike's high valuation and minimal growth outlook signal a potential long-term challenge for shareholders, while FedEx, with its more modest valuation, holds the promise of potential upside if key issues are addressed. As investors navigate these uncertainties, the emphasis on fundamental core growth, valuation, and free cash flow remains paramount. The financial landscape is rife with complexities, and the fate of these two bellwether stocks will undoubtedly reverberate throughout the market, shaping perceptions and influencing investment decisions in the unpredictable journey ahead. Please consider liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.